Imagine an investment promising over 100% in annual distributions. I mean, that sounds almost too good to be true, doesn't it?
It really does. Catches your eye immediately.
Well, that's exactly the kind of figure we're diving into today. We're doing a deep dive on the YieldMax AI Option Income Strategy ETF, ticker symbol AIYY.
Right, AIYY. Launched back in November 2023 by Tidal Financial Group.
Exactly. And it's been getting a lot of attention mainly for that, well, jaw-dropping distribution rate they're quoting, 100.8%.
100.8%. It's a huge number.
It is. So our mission today is really to unpack this. How does it work? Is it actually a lucrative opportunity? Or, as some of our sources are suggesting, is it maybe a high-yield trap, something that, quote, probably doesn't belong in your portfolio?
Yeah, we need to look under the hood, explore the mechanics, the risks.
And what it all really means for you, the investor. So let's dig in. Okay, so to really get AIY, we first need to talk about the core strategy it's based on, which is covered calls. Even if you're familiar, it's worth a quick refresher, especially before we get into AIY's specific twist. Can you walk us through the basics?
Sure, absolutely. So at its simplest, a covered call means selling a call option on a stock you actually own.
Okay.
You're essentially giving someone else the right, but not the obligation, to buy your shares at a specific price that's the strike price by a certain date in the future.
And you set that strike price higher than where the stock is currently trading?
Typically, yes.
Yeah.
Higher than the current price, with an expiration date maybe weeks or months out. Now, the buyer of that call option pays you money up front. That's the premium.
Right, the premium.
And the value of that premium, well, it depends on things like how volatile the stock is and how much time is left until expiration. More volatility, more time usually means a higher premium.
So you get paid just for offering someone the option to buy your shares later.
Yeah.
What are the two main ways this can play out?
Well, okay, two main outcomes. Scenario one, the stock price stays below the strike price when the option expires.
Then what?
Then you keep your shares, and importantly, you also keep the premium you collected. The option expires worthless for the buyer. Nice little income boost.
Okay, that sounds good. What's scenario two?
Scenario two, the stock price climbs above the strike price at expiration. In this case, you still keep the premium, which is great, but you are obligated to sell your shares at that strike price.
Even if the stock has gone way, way higher.
Exactly. Even if the market price is much higher, you sell at the agreed-upon strike price. Your upside is capped.
So that's the classic covered call. Seems like a decent strategy for generating income. When does it work best?
It works really well when the market is kind of flat, just trading sideways or maybe even drifting down a bit.
Because you keep collecting those premiums.
Right. To collect premiums without your shares getting called away. It generates income from a stock that isn't moving much.
But the downside?
The downside is during big market rallies. If your stock suddenly takes off, your gains are capped at that strike price. You miss out on all the extra profit above that level.
So good for sideways markets, not so great if your stock is a rocket ship.
Precisely. And that's why firms like Tidal Financial Group launched these covered call ETFs, like AIY. They offer a way for investors to potentially get that premium income, often from more volatile stocks which generate higher premiums without having to manage writing the options themselves.
Okay, that makes sense. But now, you mentioned AIY has a twist. This is where it gets significantly more complex, right?
Yes, this is where AIY really diverges from a simple covered call strategy.
The underlying, well, the reference stock is C3.ai, ticker AI, an enterprise AI software company.
Correct. And it's worth noting C3.ai is still trading, more than 40% below its IPO price, so it's definitely been volatile.
Definitely. But here's the kicker, the really critical difference with AIYY. Unlike you or me writing a covered call on stock we own, this ETF does not actually own shares of C3.ai.
That's the key distinction. No underlying C3.ai stock is held directly by the fund.
So how does it write covered calls then?
It writes them on what's called a synthetic long position. Yeah. Instead of holding the stock, the fund uses a combination of other options, specifically longer-dated call and put options on C3.ai that are structured to mimic the price movements of owning the actual stock.
Wow. Okay. So they're creating a sort of financial simulation of owning the stock using other derivatives. Why do that?
The main rationale is capital efficiency. It requires significantly less upfront capital to create this synthetic position compared to actually buying, say, 100 shares of C3.ai for every call option contract they want to sell.
Less cash tied up. I get that. But it sounds intricate. and it may be risky. What are the challenges with this synthetic approach? My gut says it's not straightforward.
Oh, you're absolutely right. It's far from simple. The goal is for the synthetic position to track C3.AI's price, including on the downside. But achieving that requires what they call perfect hedging.
Perfect hedging sounds difficult.
It's extremely difficult, maybe even impossible in practice. Options prices are affected by volatility, time decay, interest rates, many factors. Getting a basket of options to perfectly mirror a stock's price movement, second by second, day by day, very challenging.
And what are those long-dated options they use for the synthetic part?
That's another issue. Options lose value over time due to time decay, or theta. So those longer-dated options in the synthetic position are constantly decaying. Meaning the fund managers have to constantly manage and roll those positions forward, closing out expiring options and opening new ones just to maintain this synthetic exposure. That involves transaction costs and the risk of things getting out of sync.
Okay, so it's like juggling. They're selling these short-term calls, maybe monthly, to generate income.
Right. The strategy involves selling short-term calls, usually with strike prices maybe 5%, 15% above the current C3.AI price each month. That's where the distributions primarily come from. They also park some extra cash in short-term treasuries for a bit of interest,
while simultaneously managing this complex, decaying, long-dated synthetic position on the other side. It really does sound like a high-wire act.
It is, and it comes at a cost.
The cost. What are investors paying for all this complexity?
The annual expense ratio is 1.67%.
1.67%. That's quite high for an ETF.
It is. Our sources point out that this is significantly more expensive and, frankly, more confusing than if an investor just bought C3.AI shares directly and wrote their own covered calls, assuming they were comfortable doing that.
Yeah, 1.67% is a pretty big hurdle to overcome each year on top of everything else.
It's a constant drag on performance, definitely.
So let's get to the bottom line then. What does this complex structure, this high expense ratio, actually mean for you, the potential investor? When we look at the long term, how has AIYY actually performed compared to just holding C3.AI stock?
Yeah, this is really the crucial part. And the picture isn't pretty, according to our sources. Despite C3.AI itself having potential positive catalysts, things like accelerating revenue growth, maybe extending its big deal with Baker Hughes, new government contracts, cloud partnerships, all the buzz around generative AI.
Things that could potentially drive C3.AI's stock price up.
Exactly. But because AIYY uses that covered call strategy, even synthetically, it inherently caps its potential gains. It simply cannot keep pace if C3.AI stock makes a significant upward move. It's designed to underperform in a rally.
And do the numbers bear that out?
Starkly, over the past 12 months, the data we looked at shows AIYY's shares declined a staggering 64%.
64% loss. Wow. How did C3.AI stock do over the same period?
C3.AI's actual stock only fell about 14%.
Okay, wait. AIYY lost 64%, while the stock it's based on lost only 14%. That's a massive difference.
It is. It really highlights how that capped upside and the fund structure can lead to severe underperformance, even when the underlying asset isn't crashing.
And what about those huge distributions? Doesn't that 100.8% yield make up for the share price decline?
Well, even if you had diligently reinvested all those big distributions from AIYY,
yes,
you would have still ended up with a negative total return of around 24% over that same 12-month period.
So even adding back the yield, you're still down 24%, while holding the stock directly would have meant being down only 14%.
Ouch. Precisely. And there's an even more critical piece to understand about those distributions.
Okay.
Most of that money being paid out, it's classified as return of capital, or ROC.
Return of capital, what does that mean for the investor? Is it income?
Not really, no. Return of capital essentially means the fund is giving investors their own money back. It's not profit generated by the fund's investments or trading activities.
So it's like taking money out of your left pocket and putting it in your right pocket, minus fees?
That's a good analogy, yes.
Oh.
It's largely just returning the principal investment back to shareholders piece by piece. It makes the yield look high, but it's not sustainable income generation.
This isn't really income then. It's more like the fund is slowly liquidating itself to pay distributions. What's the long-term effect of that?
The major consequence is that this constant return of capital erodes the fund's net asset value, the NAV.
The underlying value of the fund's assets.
Exactly. And AIY's NAV has already plummeted, roughly in line with its share price, down about 64% over the past year.
And a shrinking NAV makes it harder for the fund to generate future returns, right?
Absolutely. It limits its upside potential even further. The fund is essentially eating into its own capital base to maintain those high advertised payout rates. It's not a recipe for long-term growth.
So that brings us back to the giant number that started this whole conversation, the 100.8% distribution yield. Given everything we've just discussed, the synthetic positions, the underperformance, the return of capital, what's the real story behind that figure?
Yeah, it's crucial to understand that the 100.8% figure is backward-looking.
Backward-looking.
It just means that if you take the fund's most recent monthly distribution payment and annualize it, multiply it by 12, that total amount would be equivalent to 100.8% of the ETF's current share price.
So it's based on the last payment and the current price.
Exactly. It absolutely does not mean you're guaranteed to double your investment over the next year. Not at all.
And those monthly payouts could change.
They could change dramatically. If C3.ai's stock volatility drops, the premiums the fund collects from selling calls will likely decrease, leading to lower distributions. Or if the stock price crashes, the NAV falls further, also impacting distributions. That 100.8% is just a snapshot based on recent history, not a promise.
Okay, so it's not magic money doubling. It's an annualized calculation based on the past, paid out largely from your own initial investment, while the fund itself underperforms and shrinks.
That sums it up pretty well based on our analysis of the sources.
Right, so just to recap our deep dive here, the YieldMax AI Option Income Strategy ETF, AIYY, might flash this huge yield number, making it look like an incredible income machine. But our sources paint a very different picture. They describe it as, well, a potentially dangerous investment.
The key takeaways seem to be, you're mostly getting your own capital returned to you, not real income.
You're paying a hefty fee, 1.67%, for this complex synthetic strategy.
And the fund is structured in a way that it's likely to underperform the actual C3.ai stock if it rallies.
Yet potentially experience even steeper declines than the stock if it pulls back, due to the NAV erosion and costs. It sounds like a tough proposition.
It certainly seems to have significant drawbacks highlighted by the analysis.
Which really leaves us with a final thought for you, the listener, to consider.
When an investment promises a return that just seems too good to be true, that seems to defy gravity.
What hidden complexities, what costs, what fundamental realities might be lurking beneath the surface, quietly eroding your original investment while dazzling you with a high payout rate? Something to think about.